Hello, Journal Trust here, and Warren Buffett has certain things that he wants investors to consider in 2025. In this video, I'm going to break that down for you. So let's get into it. So Warren Buffett offers critical investment advice for 2025, focusing on three key strategies. Number one, maintain portfolio discipline. Buffett warns against aggressive investment strategies like leveraging portfolios. Investors should avoid margin trading and leveraged ETFs, which can amplify losses during market downturns. Number two, seek value investments. With markets near all-time highs, Buffett emphasizes the importance of finding undervalued stocks with strong fundamentals. He recommends being extremely selective about stock purchases using a two-step evaluation process. And that entails accurately projecting a company's earnings for at least 5 years. Only buy stocks priced at a fair value relative to earnings estimates. Now, please take a moment to hit the subscribe button and the like button. Please take a moment to hit the subscribe button and the like button. Ensure proper diversification, right? Investors should spread investments across various sectors to mitigate risks. This is particularly important given recent concentrated returns in tech and AI sectors. Warren Buffett has been a net seller of stocks for several strategic reasons. Number one, market valuation concerns. The stock market's total value has climbed to roughly triple the total US GDP, a ratio Buffett considers playing with fire. He sees current stock prices as potentially overvalued and susceptible to a significant market correction. Cash accumulation strategy. Berkshire Hathaway has accumulated a record $355 billion in cash. That's with a B. Significantly more than its equity investments. This massive cash reserve suggests Buffett is preparing for potential investment opportunities during a market downturn, maintaining his famous "be greedy when others are fearful" approach. Potential motivations, you have tax considerations as well. Warren Buffett has been strategically selling stocks like Apple, partly due to anticipated future increases in corporate tax rates. He noted that selling some stocks now might be advantageous before potential tax hikes. Acquisition preparation, the cash stockpile, could also indicate Buffett is positioning Berkshire for a major acquisition. The $325 billion in cash could potentially buy entire companies like Coca-Cola or Goldman Sachs. Now, investment selectivity. With evaluated market valuations, Buffett is finding fewer attractive investment opportunities. Berkshire has not only been selling stocks but also stopped its own share buybacks, suggesting a cautious approach to current market conditions. Now, the overarching strategy appears to be preserving capital and maintaining flexibility for future high-value investments during potentially more favorable market considerations or conditions, right? There are some stocks that Buffett has avoided, and he's probably going to continue avoiding. So he avoids these kinds of stocks, right? And I assume for 2025. So initial public offerings, IPOs. Warren Buffett has consistently warned against investing in new stock offerings. He stated, in 54 years, I don't think Berkshire has ever bought a new issue. He believes IPOs are driven by Wall Street selling incentives rather than genuine investment value. We have cryptocurrency and speculative assets. Buffett is extremely critical of cryptocurrencies, calling Bitcoin probably rat poison squared. Tell me how you really feel. He emphasizes that true investments must produce cash flow, and assets like cryptocurrencies that just sit there are not investments. Commodity-based companies is another one. Warren Buffett typically steers clear of commodity-based firms, preferring businesses with more stable and predictable revenue streams. The key avoidance principles, as far as the investment criteria Buffett dislikes, is companies with unclear business models, high-tech stocks he doesn't understand, businesses without a clear competitive advantage, stocks driven by market hype rather than fundamental value. Now, Buffett, he has a golden rule. Only invest in businesses you can thoroughly understand and that demonstrate consistent operating history, dominant market position, high and sustainable profit margins, potential for long-term growth. So basically, in a nutshell, Buffett's strategy is to avoid speculative investments and focus on companies with solid, predictable, long-term potential. Now, how can you apply Buffett's two-step evaluation process to your own investments of 2025? Well, you're going to want to start with step one, identify exceptional businesses, right? The key criteria for selection is understand the business thoroughly. Look for companies with durable competitive advantages. Seek businesses that can stand the test of time, maintain strong profit margins, generate consistent returns. Evaluation metrics: return on equity, ROE, profit margins, management efficiency, long-term revenue potential. Now, step two is calculate intrinsic value. The valuation method is as goes, right? You're going to want to calculate a company's intrinsic value by analyzing revenues, earnings, assets, potential future cash flows. Now, the comparison approach, you want to compare the calculated intrinsic value to current market capitalization. Look for stocks trading at a significant discount, ideally 20% or more below intrinsic value. Now, a critical investment principle is, he emphasizes three additional, crucial considerations. Number one, only invest money you can afford to lose. Two, maintain a long-term perspective. Three, avoid emotional decision making. The pro tip in this regard: use stock screeners to find companies matching these criteria, focusing on businesses you generally understand and can evaluate comprehensively. Now, we have some top index funds for 2025 because he loves index funds. You have Vanguard 500 Index Fund, which covers 500 largest US companies representing 75% of the US stock market. The expense ratio is 0.04%. We have Vanguard Total Stock Market Index Fund, which covers entire US equity market. The expense ratio is 0.04%. You have Vanguard Total World Stock Index Fund. This global stock index tracking developed and emerging markets. The expense ratio is 0.10%. The top international and specialized index funds, you have the iShares Core MSCI Total International Stock ETF. That's the international stock exposure. You have the Fidelity Total International Index. The global market, coverage, right? As far as the top performing index, funds, you have the ICICI Prudential Nasdaq, the 100 Index Fund, 28.99% 1-year returns. The ICI Prudential Nifty Auto Index Fund, that's 21.24% 1-year returns. We have the Edelweiss MSCI India Domestic and World Healthcare 45 Index Fund, 20.54% 1-year returns. And we have the ICI Prudential Nifty Pharma Index Fund, that's 25.16% 1-year returns. You have the Vanguard S&P 500 ETF, that's the ultra low expense ratio of 0.03%. Here's some key investment advice. Choose low cost diversified index funds and consider automatic regular investment. Okay. Also consider tax efficient index funds for this year. Like we have the Vanguard, the VTI. We have the Vanguard S&P 500 ETF. Okay. Those are some tax, some things that have tax benefits. So please take a moment right now to hit that subscribe button and the like button. Please take a moment right now to hit that subscribe button and the like button. See you on the next video.